afternoon, everyone, and thank you for joining us on this webinar about unlocking the mysteries of your payslip, what every line reveals. And my two guests today is Mpumi Makhanya and then Nokwanda Msimang. Thank you, ladies, for joining us. So Mpumi is a certified financial professional. She's dedicated and accomplished in financial services. She's got her BCom honors in finance and a dual honors degree in financial planning and investment management. And she is passionate about financial planning and client engagements. Nokwanda started her financial services career through the Assisa Academy and their internship program. She's passionate about helping individuals from various backgrounds make informed financial decisions. She holds a BCom law degree and a postgraduate diploma in financial planning and investment planning, and she's also a certified financial planner professional. Thank you, ladies, and I hope everybody enjoys this session. And Nokwanda and Mpumi will now take the floor. Thank you.
Thank you so much, Rihanna. So today we'll discuss the unlocking the mysteries of your payslip, and I'm assuming that's it. Well, that's why everyone is here, and we would like to welcome you and in this webinar. So we are going to discuss what is mostly overlooked and what we define as the most powerful financial documents that you receive every month. And joined alongside by my friend Nokwanda, and together we'll talk you through everything that you need to know regarding this. Okay. So what you can expect from today's webinar is clarity on every line of your payslip. So every deduction, every contribution that is on your payslip, you can expect us to discuss that with you. By understanding these deductions, you can empower your financial decisions and know exactly what you're earning and what deductions are being made from your payslip, and that helps you spot errors very early. And we all know that mistakes happen, and such as missing overtime, incorrect tax codes, unrecorded benefits, and all of those. We will talk through how to spot that, and and how to plan effectively. Okay, next slide. We believe that payslip literacy matters because it's not just an HR document that you can look at whenever you need to file your tax, but it's something that you can look at every month, and it helps you with your financial planning, and it tells you a story about your employment, about your benefits, and all of these financial obligations that you have right before you receive your net salary into your bank account. So okay, next slide. Thank you. So we've included a dummy payslip there. It's not anyone's payslip, but the red highlighted sections just talk through unique information that is specific to your payslip, and that includes your employee code, your name, your income tax, your pay as you earn reference number, and your UIF registration number. And that is like the information that is quite unique to you, and you should expect to see that information on your payslip. And some other details may or may not be included. And this payslip is very detailed in the sense that it has a lot of information there. As you can see, it has the company address, it has ID numbers, banking details, and all of that. And your payslip may not have that information, and that's okay. But what is important is your unique details that are highlighted in red there. And also, what's not highlighted there at the top is the pay period, which is also important because it records your salary, because it might happen quarterly, biannually, monthly, and it's quite unique to your circumstance. Okay. And we'll also discuss the green highlighted sections, which are your earnings, and we'll talk through that in more detail as we go on the webinar. And there's also some light blue information there, and that is your deductions. And the yellow highlighted in that dummy payslip is your company contributions. And we'll also dissect the differences between the two, between the deductions and the contributions. Yes, Nwanda, sorry.
Sorry, a lot of people are saying they can't see the presentation. I'm not too sure. I think we are sharing. Can everyone just try refresh? But a lot of people can't see it. So just try refresh your screen and try again. Thanks. Sorry, Mpumi.
No problem. Should I wait for a few minutes, or should I continue with the presentation?
Brianna, please guide us. Still no slides.
Guys, I think just continue. People must just try and refresh. I can see it on my side.
Okay, not a problem. Okay. So let me just go back. Yes, as I was saying, the brown highlighted sections is the year-to-date totals, and the blue highlighted section would be the cost to company, and we'll just talk through all of those highlighted sections in this webinar. Okay. All right. The unique information, and that was the red highlighted bits there. The unique information is your personal and employer details, your employee number, the pay period, the date the payslip was issued, and it's usually your personal information. And you need to ensure that this information is correct as it connects to your earnings and your tax that is recorded, and all of those contributions as well. And if there's any errors on this information, it is recorded with SARS, and it can cause delays with your SARS filings and your UIF claims if it ever happens, God forbid. But if it ever happens, it will delay your unemployment insurance claims, loans, and even medical aid excess. Okay, so the earnings breakdown includes your basic salary, and it includes your overtime and bonuses. And the overtime is usually paid, it depends actually with the company that you work for, and it is usually in your employment agreement. And some companies don't have overtime on the company agreement, but some companies do offer that, and it's usually 1.5 times your hourly rate, and sometimes 2 times your hourly rate. And it's also different from the overtime that you work during weekdays, and it's sometimes different from weekends, but it needs to be in your employment agreement, and it's not usually the same for everyone, but that's usually the rate for the overtime. And bonuses are also different. Bonuses come annually, quarterly, and some are performance-based. And for performance-based bonuses, you need to understand the formula used. so that you avoid surprises at the end of the period when you're expected to receive a performance bonus. But that is part of your employment agreement, and you should know what type of bonus you are expected to receive. And some other people receive commissions and allowances in their earnings, and that's reflected on their payslip. Okay. Yeah, that's just the bit where I talk about the performance bonuses and overtime, which is already discussed.
Pumi, sorry for interruption. Yes. Could you please maybe just unshare and then reshare the presentation? Sorry, Nokwanda, people still seem to not be able to see it.
Okay, I'm gonna try again.
Thank you.
Give me a second. I'll just. Okay. Okay. I'll just present now. Hold on.
I see some thumbs up.
Is it better?
I think so. I see a lot of thumbs up.
I think so. Go ahead. Thank you.
Okay, let me just scroll. Sorry.
Not a problem.
Okay, this is where we are. Cool.
Okay. What's also important is understanding your contributions, and the contributions, we like to see them as not a deduction, but a contribution to your financial future, because a lot of these contributions build you. They are powerful tools in there, and they're quite important for your personal and financial planning. So for a lot of these contributions are split into two. In your payslip, sometimes there are usually employer and employee contributions. And the employer contribution is what the company is responsible for paying for you, but that's also included on your cost to company. And I'll also show you that payslip again so that you can see how it affects your payslip. But we like to see it as the deductions are really different from the contributions, because contributions build your future. And as you can see there, provident fund, you won't see it as a deduction, and you shouldn't really see it as a deduction because you are paying yourself there, and you will receive those benefits in future when you retire, and that's quite important. And if you look at things such as your life cover, that's also very important for you, so that in the case that you pass on, the family has something to receive at the end. And your disability cover, your medical aid is also important. Your severe illness is also very important. I think it's also important to know that some companies do not have group benefits, because what I've just mentioned there are called group benefits. And some companies may not have the provident fund, they may not have life cover. Some companies may offer more than what is represented in this payslip here. But it's really important, yeah. Just move on. Deductions are deductions such as your pay as you earn, and that would be your income tax. And that's why I mentioned that it's important to note your pay as you earn number, because that goes back to your income tax. And Nogwanda will discuss more about the tax and how your salary is taxed. And yeah, the UIF is also a deduction. Sorry. Oh, had you moved?
Yeah, sorry.
Okay. So UIF is also a mandatory deduction, and it's usually 1% of your salary. And everyone has that deduction on their payslip. And there's also an SDL, which is called the Skills Development Levy. It's usually paid by your employer and is reflected in your payslip. And that was part of the company contributions. Okay. And there's also medical aid and retirement contributions. And they are, like I said, they are often split between you and the employer. And it is important to know how much you're contributing and whether it aligns with your financial goals, because the minimum that you could be paying towards your retirement contributions could be so low, but that doesn't mean that's where it ends. You can contribute more towards your retirement goals. And moving on to my favorite slide, and I think it's also Nogwanda's favorite slide, because it just shows a picture of the real catch here, which is the gross pay versus the net pay. And a lot of us think that the gross pay is what we will actually receive in our bank accounts, but the net pay is what we actually receive, and that is the small spinach there in that pan. And that is your take home after taxes and deductions. Okay. And I wanted to show you a real and practical example of how it really affects you, the gross pay versus net pay, because on there, the dark blue highlighted section is the gross pay, and that's the total cost to company. And it can, as you can see, that's 25,000 rands. And that light blue highlighted section there at the top is your deduction, and that includes all of your deductions, and that will be the company contributions, your tax, and that leaves you with a net pay of 17,600. That is a total of 17,000 of deductions. 7,000, sorry. And what you receive in your bank account is 17,000 rands. So yeah, that's just a practical example that when you receive your offer letter, you often think, yeah, I'm going to receive a gross salary, I'm rich, I'm going to buy all of these things, I'm set for life, I will earn 25,000 rands, but what goes into your bank account is 17,000 rands. Okay, and this is one of our second favorite slide, and that basically means if you don't pay income tax, that basically means you don't have an income. And with that being said, I would like to hand over to Nogwanda, which she will discuss income tax and how you can use tax as a way of making the most out of your salary and your retirement contributions. So, Nogwanda.
Thanks, Bumi. Thank you for that. Hi guys again. So I've got the least favorite part of the presentation, which is tax. We don't like paying tax, guys. If we could avoid it, we would. But unfortunately, it is a reality. And as per the previous slide, if you have an income, you're going to pay tax. So a lot of the times we see these amounts going off our pay slip, that 2.7 in pay as you earn, but we don't really know how it's determined and how it's derived, usually in most instances. And your tax rate is basically it's based on your annual taxable income, and so the higher you earn, the higher your tax rate will be. So SARS uses this sliding scale to determine how much tax each individual at any given point will pay. So if you earn 400,000 rands per year, for example, you would fall under this brackets, the 31% brackets, right? So that's how it's sort of determined what your tax rate will be. Okay, and then the tax period, if anyone doesn't know, wants to refresh their memory, the tax year runs between March of the previous year and February of the current year. So in simple terms, it's the 1st of March. So in the current tax year that we in, run from the 1st of March 2025, and then it's going to end on the 28th of February 2026. So that's how it works. But your pay as you earn, which is the tax on your income, is deducted monthly, and your employer has the responsibility to deduct it and pay it directly to SARS on a monthly basis. Okay. Now, let's talk about retirement fund contributions. How can that assist you with your tax? So we like to refer to the section called Section 11F deductions, which what the Act basically says, the Income Tax Act says, you can deduct up to 27.5% of your taxable income or your remuneration, whichever is greater, capped at 350,000 per tax year. Simply put, if I earn 400,000 per year, I can deduct from that up to 27.5%, which is about 110. So I can then only get taxed on 290,000 versus the full 400, right? So I pay less tax if I contribute towards my retirement fund. So so contributing to your retirement fund is actually a great way to help you reduce your tax. The other way is through your medical aid. Although medical aid does not qualify for a deduction as such, but you receive what is called a medical tax credit or a rebate. So every person that's on your medical aid receives a specific amount you receive a specific amount as a rebate. So rebates being once the tax is calculated, once all the deductions that Mpumi spoke about are calculated, and we have that tax amount, then you can further reduce it by that rebate that you get if you have medical aid. Other thing that can be considered is out-of-pocket expenses. Most of us who are young professionals are not on like very comprehensive medical aid schemes. We're on probably like hospital plans or the basic of plans. And so what happens there is that usually some expenses aren't, your medical aid doesn't cover for those, but you can always gather that information when you submit your returns, and you may, I must put a disclaimer, may qualify for an additional rebate for that as well. So how I've done it over the years, just to give you like a practical tip, is even if I know, like, let's say my benefits have run out, I still claim via the medical aid just to keep track of these expenses, because it's very difficult. You get sick throughout the whole year, but how do you practically keep tabs on it? So how I've done it is, even if I know, okay, I've run out of my savings in my medical aid, I will still go and claim using my medical aid, and obviously they will reject it because there are no funds, but at least then it's on my medical aid app, and then when comes tax year end and I'm submitting my return, I have all those records so that it helps me when I file my tax return. Otherwise, if you buy medication via Dis-Chem or any other pharmacy, you keep your slips. That's the old school way of doing it, but it still works. And then if you feel like you can benefit from that rebate, then you add it and build your case, or when you file your return. Hope that makes sense. All right, so what happens then if your company doesn't have a pension or provident fund, but you still want to benefit from these tax deductions, right? So that you can pay less tax. So if your employer doesn't have a pension or provident fund, you can open what is called a retirement annuity, which is basically the same thing. The only difference is that there's no employer-employee relationship. You just go directly to a platform like, for example, Allen Gray, and then you deal with them directly. But then now the question that we thought about is, okay, because if, as you would have seen when Bumi was showing us the example in the payslip, that deduction of your provident fund reduces, as we have explained, will reduce your taxable income and your pay as you earn monthly. How do I do that if I have a retirement annuity, right? So We have an example. Meet Nomathemba Zwane, made up fictional character, and she earns 35,000 rands a month. Her company doesn't have any benefits, so she's thinking about saving or investing in the most tax efficient manner. So we can agree that Nomathemba has 3 options, right? The first option, she doesn't even bother opening an RA. The second option is she opens an RA and uses her after-tax money, so her net salary after deduction, so whatever lands in her bank accounts, she doesn't account for that 3,500 deduction on a month-to-month basis. So once the money reaches her bank account, that 17,000 that we saw on the other payslip, she then takes 3,500 rands and pays it to Alan Gray into a retirement annuity. Or the third option is the RA can be deducted before tax. So her 35,000 less 3,500, and then the difference is taxed. So she has those 3 options. I'll explain it. It does sound a little bit complicated, but we'll see how it works practically. So if we look at this slide, if she does not have an RN, she does not contribute, her monthly tax amounts to 6,289, and she gets a very nice final cash flow net salary, right? It looks great, but she still has a very high monthly tax rate. And on top of that, she doesn't save anything tax-wise on a monthly basis, and also there's no rebates, right? So that you get, it's like a lump sum. Hopefully at the end of the tax year when you submit your return, you get a nice fat lump sum in your bank account, right? She doesn't get any of that, okay? And she still pays a higher tax. But if she takes her after tax money that's in her, and she didn't tell her employer about it, it's not included in her payroll system, and she decides, okay, after tax she'll pay it herself and she won't let her employer know that she has an RA, she still pays higher tax monthly, which is 6.28, similar to the first scenario, but her final cash flow is less, right? Because then after that 28,533, she will pay Alan Gray 3,500. But the nice thing is, so she's not saving tax on a month-to-month basis, but she stands a chance to get a nice rebate at the end of the year, like a nice chunky lump sum. Then option 3, Nomathemba goes and tells her payroll officer, look, I want to save on a month-to-month basis. So the payroll officer accounts for the deduction at before they pay her income. So they'll deduct 35,000 and they'll deduct 3,500 from her gross, and then her final cash flow is 26,000 a month. So the difference between the two is that she gets more money in her bank accounts because it's reduced her pay as you earn on that month-to-month basis. So she's saving tax 1,000 rand plus, but then she doesn't get a rebate. So I hope that makes sense. So what we can see is that if you don't have this RA option, or any pension fund for that matter, you don't have a tax benefits and you pay more tax. But option 2, so now your question would be, which option would I choose, option 2 or option 3? It's the same thing. If you times this 1,085 by 12, you land up with this 13,000, right? But the second option is good if you want a big tax refund. So this 13,000, if you want it in July and you want a nice lump sum, it's good for that, right? And but option 3 is good for cash flow and tax savings, meaning like you get more money during the month. So it just depends on what you want. If you want like more access to cash flow during the month versus waiting until you submit your return, then you can choose either of the 2 options. Okay, so they're both good options. It just depends on what you as a taxpayer think is best, the bigger lump sum or the extra 1,000 rands that can probably help you during the month. All right, so we've spoken through this. And then year-to-date totals, we've just included that this is also something you'll see on your payslip often. So it just shows you cumulative earnings and deductions for that period or the year. So this payslip, I think, was up to June. So this person would have paid 22,000 up to June and would have earned 185 to that period. But this is very helpful. It's a very helpful tool for us in financial planning because it shows you your taxable deductions. So she's only contributed 13,000, so she can probably contribute more. It allows you to determine, oh, and I've got 100 and I can contribute up to 110, so let me add more if I can, right? And it just helps, like if you get bonuses and you see that reflected on your pay slip, then you can start now planning towards topping this up. Or you see here it says private contributions are 0, you can start adding to that as well on your personal capacity. So this is a very nice tool to help you, show you where you are and where you want to be. All right, this is one of the most important slides of the presentation, spotting any discrepancies. As Mpumi has said, we are human and there are likely to be errors sometimes. So it's very important to check that the correct deductions are applied. So if you are saving 2,000 Rand and your employer only has it as 200, that's obviously going to affect you. So note that. If you can see that your income tax number is wrong, note that. And if you can see that you've worked overtime twice this month but it's only been accounted for once, it's important for you to check and make sure that the correct deductions are being applied, the correct information is being applied. And then the second point, this one, guys, make sure that what is being deducted is going towards where you think it is. And this is so important. Like we see so many things going off, Discovery, Momentum, Alan Gray, but we don't really understand, we've never really seen these things, right, in practice. So it's really important. We actually, both me and I actually have, both have met people who, let me share my example. So this person had been working for this company for like a year and a half, close to 2 years, and on the pay slip it had reflected that he was contributing monthly to a provident fund. He had never received any statements. He didn't know who the administrator of the provident fund was. And then he got retrenched, unfortunately, and when it was time to go claim for this provident fund, it turns out that this provident fund wasn't even registered, right? So and you can imagine now he's worked so long and he thought, I'm gonna at least have some cash flow for the next couple of months, to only find out that that thing didn't even exist, right? So it's scary. So just make sure that you know, okay, if my company is saying I'm contributing to funds at work, have you seen your statement, your recent statement? Is it reflecting the correct information? Are your beneficiaries correct? If it says I'm contributing towards Discovery Life Cover, have you seen it before? Do you know what you're covered for? Do you like you may find that it says dread disease and yet you want to be covered for like capital disability. Like just make sure that what you think you're contributing to is in fact what you are contributing to. And then if there are any issues, just report to your payroll or officer or your HR immediately, and they should be in the position to help you. Right, so we're almost there at the end. So pay slips and financial planning are really important, as Mpumi has already touched on. For us, it's really important to see it so that we understand your true total compensation. So as Mpumi had alluded to, what makes up your total compensation to the company. So all those company contributions, so that you know what the company is actually paying for and what you're paying for. It's also very useful for budgeting and saving, because now you know not to budget on your gross but your net, and which is what you actually receive at the end of the month. Then from there you can start seeing, okay, I have this amount of money available. Then you can allocate it to your debts, to your savings, whatever that you need during the month. And you can also see things like, how much am I contributing to my provident fund? Is it enough? Can I add more? Etc., etc. It helps you verify income for credit applications such as leases, such as cars, such as home loans. So it's seen as a very important document, very accurate, that's the right word, accurate documents of your employment and how much you actually earn. And then it also helps you understand what benefits you have through the company. So sometimes we meet clients that they don't know that they actually have life cover, or let's say capital disability, as I've alluded to, and by just looking at the payslip you can see, oh, capital disability through discovery, and then it helps us access that information quicker. So it's not just a thing that you get at the end of the month, it's also very important. It helps you see your position and also your leave days, guys, which is very important to check. All right, and then the last slide, final takeaways. Know your pay slips in and out. Monitor changes. Don't just glance at your net pay. Understand what you are paying for. Understand where your money is going. Understand how it affects your future, right? Monitor it on a monthly basis, not just at tax season. Make it a habit to review your payslip every month. Like, spot errors, track benefits, like stay informed about what's going on in your life, right? Essentially, and use it as a planning tool and not just an HR document. It's a very important tool. Use it to budget, prepare for retirement, use it for tax seasons. Like, just use it as much as you possibly can. And then 4, this is very important, take advantage of tax efficient opportunities, guys. Paying tax is not nice, so if there's a way for you to reduce the tax that you ultimately can pay, use it. And saving in your retirement fund helps you at your when you retire, guys, so that you can ensure that you are financially free when you reach that stage. And then the 5th point is just be proactive, not passive. It's not just if something doesn't look right, speak up. Like, if you've never seen your statement, I know I keep alluding to the statement, but if you have never seen your Provident Fund statement, ask for it. It's yours, right? See it. Be proactive and speak up. If something's wrong, if you don't understand a line item, like for example, your UIF last month was 180 Rand, and now it's all of a sudden 500 Rand. Question it, ask questions. And it's all about empowerment, guys. So financial literacy starts with understanding what you earn, how it's taxed, and what's being set aside for your future. The more you know now, the better decisions you can make. And that's it from us. Any questions?
Guys, so there is a question. Let's have a look. It says, just going back to your tax savings on your RA contribution, if she's contributing 3,500 Rand a month, which comes to 420,000 per annum to an RA, and earning 422,000 taxable income, surely the rebate is 42,000, as she's below the 27.5 11F contribution limit.
Sorry, I just want to stop sharing. Can I read it? I'm very bad at listening to read. Okay, so just going back to your taxi on your RA, if she's contributing 3,500, so then earning 420, surely the rebate is, so that no, so that's not how the rebate works. So you must remember that your contributions towards your RA reduce your taxable income. So I just want to share my calculator, right? So you're still, so if you earning 420 and you contribute 42,000, right, you're gonna get taxed on this 380, right, and the 378,000, right? But they are still, if we go back to the slide where there's a sliding scale, so the sliding scale firstly has to be applied, right, and then that determines how much tax you'll pay, then less, and then then you have to still deduct obviously your primary and secondary rebates. It just depends on how much tax taxable like how much your taxable income is calculated at, and then it just reduces how much tax you pay. So it doesn't guarantee that you're going to get the full rebates. That's not how it works, unfortunately. It just reduces how much tax you're going to pay. And then if you get a rebate after all the sums are done, then that's like a bonus for you. I don't know if that makes sense. I hope it does. But it doesn't mean that because you're contributing 42,000 rands, you get that full thing back. I hope that's right, and I hope it makes sense. Okay, let me read other questions. Any recommendations for tracking and checking? Any recommendations for tracking and checking this on the go? I'm not sure what you mean. Can you maybe elaborate on that question, and then we can mobile app.
A mobile app. I'm also not too sure what she means.
I see there was a comment to say there's a useful online calculator, such as TaxTim. I'm not sure if there's any others.
Yeah.
Yes, I forgot to mention that, Rihanna. Actually, that's my favorite tool at the moment. I use that to help me estimate like what I can expect. And it also, with your contributions, Craig, you can just go on there and add like, okay, 42,000, you've contributed 42,000. That calculator will actually show you what rebates you can actually expect. So that's a very nice tool. Thanks for that.
And I see the next tip is also, it's regarding your leave, is to use a spreadsheet to make sure that your leave calculations is correct. I think Excel spreadsheets are still a very important tool for a lot of us to use. Guys, then the next one, it says, practically, how do we get an employer to deduct personal RA contributions? What is the actual process? I don't know whether you guys are able to answer that.
I am able to answer that question. So what they can do is get an overview from the platform wherever you invested, whether it's Allen Gray, Momentum, whatever platform you invested in, and anything that can prove, a piece of paper that can prove that you're contributing to your retirement annuity, you can use that to provide it to somebody from HR and just hand them that piece of paper, and they should be able to do that little calculation that Nogwanda did, that will determine your net pay, and that should be fine.
And you just let them know, and then they will account for it on your IRP5 and send it to your to SARS, and then it will deduct. So using that information that you get from the platform, the overview, so take it to the payroll officer. This is what I'm contributing. Can it be accounted for in my IRP5? And they should be able to assist you.
Something else that's also important is if you miss a debit order, SARS will know. Your HR may not know that, and you will be able to get that 1,000 or extra that you would receive on a monthly basis, but SARS will know that you've missed 1,000 and you have to pay it back at the end of the tax year.
I think what I forgot to say, the most important thing about that option where you let your payroll officer know about this, it keeps you accountable, and it's like also you don't want to keep going to them and saying, "Ish, guys, I want to change my debit order." It keeps you accountable for that period, right? So, and if you miss it, you SARS is going to flag you. So you just rather just keep it like that, keep it as it is, and let it run as you've planned for the year.
Right. I see there's a very nice suggestion or a comment that says when an individual is paying their RA contributions before deductions, so the tax savings portion can be used in your savings and investment portfolio. I think it's important to not spend that saving, but to reinvest it so that it provides you with a decent pension at the time of your retirement.
And also, if you have, Rihanna, if you have like debts, like a car loan or anything like that you want to add more to reduce that as well, it's a very good option to do as well, because debts also compounds, so it's nice to just pay it off as soon as you can. So if you have an extra 1,000 rands that you can add to your bond, for example, do it. It helps you.
Absolutely. Paying off debt really creates a saving. I see a question here from Sianda, as says, might have missed this section. With regards to tax, do you need to manually pay tax during the tax season, or does the UIF section of your payslip cover the whole tax thing?
No, there's two differences if I understand that question, because I'm also as equally bad as Nogwanda that I have to see that question. But UIF is something completely different, which is deducted, and it's your unemployment insurance fund, and the tax is deducted, and that is the pay as you earn in your payslip that gets deducted every month from your salary, and that's paid over to SARS by your company. And if there's any stuff that you need to pay off, or there's other stuff that you owe from SARS, you still need to pay that portion, but that's a different story, and that's completely unique to you. But currently in your payslip, what you'll have is your pay as you earn, and that's the tax that you pay every month.
And also, the biggest mistake, Sianda, that I made when I started working is I didn't file my return, because I thought, pay as you earn is covered, so I don't need to file my return. But you do need to file your return. I got a penalty, by the way, so you don't want that. You do need to, and Bumi told me about it, by the way. So you do need to file your return annually in July. File it. It's very easy to do on your e-filing app, and it takes you through line by line. So your most of the information is captured on there automatically, most of it. So that's your income and anything that your employer would have recorded, and your pay as you earn. But other things like if you have a tax-free savings, like maybe that didn't pull through correctly, or your out-of-pocket expenses that can really help you reduce your tax, you still need to file your return. So annually. Otherwise, you will get penalized like me.
Thanks, Nokwanda. We've got a question here from Lorato. If I increase my provident fund contribution percentage from, example, from 8% to 12%, does that also reduce my tax?
Yes.
Yes. Up to 27.5 or 350. At 350. So yes.
So if that 12% equates to 350, or even more, maybe 400,000, you will only receive a cap. It will be capped at 350. So whatever you contribute above that 350, you will not get a tax benefit on that.
Thank you. Next one here from Sandy. For a one-member business owner, which would be better between setting up a retirement fund or an RA, which will be paid by the business? So the business is paying for it. Which is best, a retirement fund or an RA?
A retirement fund, that would be a provident fund, I'm assuming.
Which is best? So you're a sole prop, it's your business. Am I understanding that correctly?
Yes.
Yeah.
Correct.
I would say an RA, because there's some cost to setting up a provident fund, and I think there's minimums for employees that need to be a part of that group scheme. So if you're the only person in that company, then it would be best to go the RA route. You're not paying any fees for that, and I'm not saying that you pay fees to be part of a group scheme, but there's minimums to that. And I think the minimum is 10 employees. So if you're the only one in the company, rather set up a group RA. An RA for yourself,
That is right.
Yeah.
Okay, question here from Natasha. What happens if a company you worked for closed down and SARS are asking for tax certificates? How do you prove that you were earning below the threshold?
In an ideal world, the company should retain records, including your IRP5 information. So you can, if the company is closed down, I'm sure there are still people or contacts that you can reach out to that will be in the position to provide you with that information. To prove it, so everyone should keep records minimum 5 years. So in an ideal world, that like any person that was involved in the business, like an HR, or they should be in a position to help you. I don't know if that helps. Yeah, that's a very difficult one.
Yeah, and if the RIP5 reflects something else, so if the RIP5 reflects that you've been working in that company and you've been receiving an income for 12 months and it was actually in fact 5 months, then it should be queried. You should go back and query that with the company that you worked for. So that were the delays that we mentioned before, that you need to check that information, check if it's accurate and stuff. But unfortunately, the IRP5, you receive it. I think you receive it after you've been retrenched or left that company. So you should receive that and prove it. And if that comes up immediately after you've left the company, maybe after 5 months, and there's some discrepancies there, go back to the HR, question them, just have them correct that error. And
essentially also sorry, go Rihanna, sorry.
So surely your payslip will also be a form of reflecting the figures, and hence you guys are saying people need to make sure that they check the payslips to make sure that it's correct, so that if there is discrepancies, you can immediately have that corrected, and in a case like that, you will have a payslip that you can fall back on.
100%, yeah.
Okay, let's see what else we have here. Employers operating a small business, let's say a funeral parlor in town, what retirement fund could that employer opt for? Looking at affordability and course of traditional retirement fund is expensive.
So for like small, where small businesses, we usually do like group retirement annuities, which is minimum of like 10 people, as Mpumi had alluded to. So through any of like the providers, I know the one I've used before is Alan Gray. I keep alluding to it. I do love them, but like they have it, but they have minimums. So minimum 10 employees, and I think the minimum contribution per employee is 1,000 rands. So you could look at something like that. I know 91 also does it. But if in the case where you don't have the numbers, you can always open individual accounts for your employees through any provider. Like you can always open RAs, and you can still help, you can still contribute as an employer for your employees in the RAs, and it will be included as a fringe benefit in their payslip. But you can either set up a group scheme or individually per employee if you don't have the numbers.
So thank you, Nakwanda. I think what's important here is for people to really consult with financial professionals to help them to set up the most appropriate and affordable options for their individual circumstances. Am I correct?
Yes,
100%.
And you can find professionals like this on the FPI's My Money 123 website, where you can search for financial professionals in your area. I've got a question that I want to pose, if you don't mind. So on my payslip, I see something that says life cover. What does that mean for me as an individual in terms of my financial planning? What is the significance of having life cover in place?
Well, I'll take that question, and if you want to add on, Nwanda, you can. But I'm sure it's quite general that life cover is important for every individual because it also goes back to that quote that we usually hear that nothing is certain except death and taxes, and death is certain, and it will happen, and it might happen earlier than you intended to be. And if that happens and you live your loved ones without that are especially dependent on you without something to fall back on when you pass on, it's going to be very difficult for them. So it is important for your estate, just covering your debts after you pass on, and just to leave something for your loved ones. So yeah.
Do you have anything to add, Nokwanda?
Yeah, it just, and also as you said, like you don't, if you have young children, if you have elderly parents, you want to make sure that, and if you're like the breadwinner at home, you do want to make sure that if you pass away, your people are taken care of. So life cover is really a good way to do that, and it gives your beneficiaries a nice like amount to be able to sustain them for whatever educational expenses, to get a house. If you have an outstanding bond, that can be paid off using your life cover, so that when you pass away, your family doesn't have the burden of trying to figure out what they're going to do without you. So yeah, it's very important. It's a very, very crucial aspect of financial planning that people often overlook, but the benefits are immense. We can't stress it enough. And usually, and also just to add something else, it's a very liquid form of cover, meaning it goes directly to your beneficiaries. So it doesn't take long to wind up. It doesn't take, it's not like your estate where it has to go through the master and get wound up. No, your beneficiaries can submit the death claim and it gets paid to them, so they have liquidity easy and quickly to move on in the event that you're not there.
Yeah. And I would also highly recommend for the people on this call where the companies don't offer a group life cover benefit, for them to consult and seek somebody for help and assistance and get life cover for themselves. Yeah.
So if I can just sum up the life cover question, every entry on your payslip is important, and every entry on your payslip means something. So if you see something like life cover, what is the meaning of that entry? And Nokwanda and Mpumi has discussed that in length now. It is a very important component of our overall financial planning, as it provides for our small children or elderly or the people that we leave behind, or to cover our debt. So it is important to realize what every entry means, even if it is paying your taxes. I want to quickly go to one last question, and that is, let me just quickly find it. What is skills development levy? Anyone?
We're laughing because we spoke about this at length and we knew that this question would come up. So best way to explain it, it's actually paid by your employer. It's as the name suggests, skills development. So if your employer has a payroll of, I think, minimum 500,000, they have to pay this levy, and it goes basically towards training and upskilling your staff, so through education, learnerships. So it forms a part of your cost to company, so that gross salary, that and then in that your employer deducts that, I think it's 2%, so that they can cater for you to go through to webinars that are paid for through the FPI, or if you have memberships, they can pay for that. It's just a way to promote employers to upskill their staff. So it's just a tax for employers. I hope that makes sense.
Thank you, Nokwanda. And I think on that note, we are going to close the webinar. Thank you so much for everybody that was online. I trust that you found it very informative. I think both our ladies were very skilled in what they were presenting. We are so happy to have had you on the call, and I hope you guys join us for our next webinar, which will be, I think, on the 25th of June. Please watch out for the communication that will be sent out. Thank you so much, everyone. Have a lovely afternoon.
Thanks, everyone.
Thank you,
Bye.
everyone.
Thanks, Rihanna.